Hey everybody, welcome to Mortgage Today for Thursday, December 28th, 2023, and oh, what a day it was. MBS were giving up much of yesterday's gain right off the bat this morning. The UMBS 6.0 was down 16 basis points. The 5.5 was down 14. Bonds were modestly weaker in the overnight session, with half of the weakness in Asia and the other half in Europe. All told, 10-year yields rose from 3.79 to just over 3.82, which is not much. Then we got jobless claims that came in at 218,000 on a 210 forecast, quite a bit higher. 206 previously, so maybe the Fed cuts are actually starting to hit jobs. Continuing claims came in at 1.875 million. It was 1.865 previously. Wholesale inventories came in at negative 0.2 on a negative 0.2 forecast. It was negative 0.4 previously. The U.S. trade balance came in at negative 90.27 billion versus negative 89.56 on the last print, creating an even larger deficit that will likely be a drag on quarter four growth. Futures of the NASDAQ are already at a record and up 55% this year, which is the most since 1999, rose by 0.2%. S&P 500 contracts were little changed after the benchmark edged within 0.3% of its peak from 2 years ago. The swaps market are pricing in about an 84% chance of a cut by March, though traders will be watching weekly jobs data later Thursday for further cues in the outlook on rates. While the equity bull market has been unstoppable, it looks unusual. 72% of equities in the S&P 500 have outperformed. 72% of equities in the S&P 500 have underperformed the index. This is the highest total since at least 2000. 2020 was the next worst year when slightly over 60% underperformed. Within the 11 sectors of the S&P 500, except for tech, where 39.7% of the firms underperformed, elsewhere the underperformance has ranged from 54.5% to 97.3%. Fidelity Investments quarter 3 2023 analysis reveals a surge of hardship withdrawals and 401k loans addressing short-term financial challenges. By the numbers, 3% took hardship withdrawals, up from 1.8% in 2022. Most people would look at that and say that's a 1.2% increase, not a big deal, but it's actually not that. It's more like a 70% increase. 8% tapped into their 401k loans compared to 2.4% last year, so like 350%. The silver lining is retirement balances are on the rise and saving rates remain steadfast. Bonds failed to do anything remarkable on Thursday, as the random strength seen in Wednesday's session was mostly erased. This wasn't any obvious catalyst for moderate overnight losses, nor for the additional weakness leading up to the 7-year auction. Perhaps traders were apprehensive about the auction considering the weak results. At that point, we had our only logical correlation of the day, which is weak auction equals higher yields. But nearly all of the volatility was contained inside yesterday's trading range. The UMBS 6.0 ended the day down 23 basis points. The 5.5 lost 2 points. The 5.5 lost 23 as well. So we ended the day on the 6.0 at 101.56. So at 101.56, that is putting us just above this Fibonacci line and just below this one. So we've been bouncing between these two very close Fibonacci lines, which, considering this trend, is kind of nice to have some stability, though we'd like to break up here. Hopefully we'll get some news for that. We also got a post from our sponsor at wellthatmakesense.com. This is part 4 of a great series on the awesome book influenced by Robert Cialdini. This is all about the power of social proof, because everyone is doing it is the reason everyone is doing it, which is the reason why your customers will do it. So this will teach you how to use social proof to sell more goods.